Welcome, everybody. Happy Wednesday. My guest today is Lance Ippolito. Lance, welcome.
Hey, James. Well, markets are 45 handles off the highs, and we've got a lot of rotation out of tech into travel names, which is bizarre. Now you're starting to see money come out of everything. So, yeah, past few days, all the Corona safe plays have been liquidated into financials and retail. Interesting. Ooh, Autodesk puts. Did
That's
you see this?
interesting, especially.
What's that?
I'd say that's really interesting considering banks are starting to report earnings, which are uniformly horrifying.
Yes, I was talking to some friends who still work at some of the banks, and they are just, they're like, Lance, our quarter is so bad. Like, things are so bad right now, and a lot of them own stock, and like I just got a text right now. Big back will be up on our avenue till Q3 results, then down again, then back up. City will finish the year at 60. Yeah, and I'll win the lotto. Some things aren't true.
Right.
But yeah, my friends in the industry, they saw how bad just the banks got hit, and I mean it's a 2-day rotation so far, so we've seen this before. My hopes don't. I don't get excited seeing a 2-day rotation.
No. So what's the opportunity? What's the risk?
Yeah, I think people are getting complacent, thinking stocks are safe right now, and you've seen Robinhood, or we can say retail, the amount of call options being bought, the amount of trades, the amount of ETF holdings for Robinhood, TD Ameritrade, and Schwab users has basically went through the roof over the past month. So that's telling me that the average Joe is getting into the stock market, and when that happens, usually there's usually some pain ahead. Retail is outperforming hedge funds this year, but I'm starting to think people are thinking stocks are safe, and when that's the case, usually we see some pain. So I think we see a little bit of a downdraft short term, and where we go 2 months from now, I don't know, but it's healthy rotation, I will say, because your Amazon, Facebook, Apple that held the market up or really rallied this market higher, they're starting to have outflows, so which is good finally.
Right. Okay, so retail is wading back into the fray based on the impressive performance of the market as a result of fabricated stimulus injection, and that's probably not a very accurate assessment of the conditions in the market. So sentiments return on false pretenses, and as you say, that's the setup for another great leap downward. We're going into the summer months where liquidity starts to lighten up generally. I mean, the non-algorithmic liquidity starts to lighten up, and that tends to facilitate a downward bias in the market, as the notorious algorithmic bias tends to overwhelm the retail manual trade, if you will. So then, is it time to go short?
You bring up a good point with Fed injecting stimulus into the market. That's what's propped up our markets, and we just saw, I think it was Japan and I want to say Germany, one of the European countries, overnight add more stimulus, And that's why our markets, the Dow futures, for example, were up about 400 points in the overnight session. So it's hard to fight the Fed. It's hard to, bet against when stimulus is happening into the markets. And we've seen the Fed buy junk bonds recently as well. So it's hard to say, okay, well, the whole world's going to, the whole economic global outlook is going to downturn and I'm going to be short stocks. A lot of smart money has been short stocks and is short stocks, and they're getting ran over. So why is now the time? I can't give you that answer. But what I can say is I think it's good to have exposure to the long side and have exposure to the short side, however you want to do that, or maybe safe asset classes like bonds or gold or silver. I think you really have to be diversified right now if you want to play the market at this time period.
Mm-hmm. So the financials and retail, that money is rotating into out of tech. What is the opportunity there? What kind of names can we look at that might actually deliver some joy to us?
I don't mind regional banks. So KRE is the ETF for regional banks. I don't mind them. When you look at Fifth Third Bank, Huntington Bank, even Regions Financial, Fifth Third Bank had insider buying, SYF even. Those kind of names, I don't mind because they haven't rallied off the lows like, let's say, a Facebook has, right? They have a lot of room to the upside from a technical perspective. But from retail, and this is what's mind-blowing to me. I was actually just listening to a podcast on this. You have your retailers like TJ Maxx, Burlington Coat Factory, Kohl's, Macy's. Macy's is already, it's a $5 stock, so we could discount that one. But your names like TJ Maxx and Burlington specifically, they're outlet retailers. So they have already discount clothing, inventory. They do not have an online presence. So a name like TJ Maxx, they didn't have, their online website was shut down for 2 months. So you can't go in the store. You can't shop online. They have all this inventory. Rats are getting all over it. It's getting spider webs. It's from previous season. They didn't even, all their summer inventory, or spring inventory, I should say, it's past. And these names have bounced off the lows. A lot of these names are trading within a 10% of their prior high. Names like that, I do not get. I do not get the rally. I want to go and buy puts on all of these names right now and call the top, but timing is so difficult to do right now. I look at other retailers like a Lululemon or a Nike, where Lulu's trading at a 52-week high. Nike's trading right by its 52-week high. The stores still aren't all open in the mall. You can't go and buy yoga pants, or you can't go to a store at the mall to go buy your Nike shoes. You have to order online. And I get it. They do have very good online e-commerce. But to me, that's not justified enough to have at least 2 months of physical shopping not taking place. It's baffling to me. Nobody's going to Kohl's or Burlington buying a coat, but yet the stocks don't seem to care. I think we're going to see a downdraft in these names. Ralph Lauren just reported earnings. They missed top and bottom. Stocks up. So it's hard to use logic. We try to be logical investors or traders, but it's very difficult right now when you have a name saying, hey, our same store sales are down 90%. Our year over year revenue is down 85%. We missed earnings top and bottom. We don't have any outlook. We're cutting guidance and the stocks are going up. How? But that's what's happening. I have this debate to myself, and this is what I think about, in my free time. And it's baffling to me that a TJ Maxx has earnings, the stock rallies 10%, and I don't get it. You can't pay rent for 2 months. You can't get rid of inventory. Yet these stocks are right near their prior levels before the coronavirus.
Sure.
So, and I love retail. I love trading retail, but I can't I can't get long them. It's hard to get short them too.
Right. Right. So is it basically a time to return to the sidelines and keep your powder dry?
It is. I want to buy puts on all these names. I do. I want to buy Under Armour puts. I want to get back into it. Tom Brady does a charity golf tournament. His Under Armour pants rip. Stocks up 3% the next day. I know how bad fundamental wise some of these companies are, but timing is so difficult right now. And I can't stress that enough. It's if you have Macy's, Kohl's, TJ Maxx, Nike, Skechers rallying 20% in a week, I don't care how bad Under Armour is, the stock's going to be up 10 to 15% too.
Yeah. So is that the really opportunity now, is the contrarian play? If we see earnings scheduled for release from a retailer and we know that same store sales are going to be down dramatically, can we more or less bank on a 10-15% run in the stock upon earnings release?
To the upside, yes. James, you can give me, and I've said this for months now, because this is how out of whack. When earnings season started a few weeks ago, this was my logic. You can give me the earnings right now of, let's say, Burlington, which reports this week. You can give me the exact earnings, the conference call transcript, exactly what the CEO is going to say, and I wouldn't know to buy or sell it. I wouldn't know to get long or short it. It could be revenue 0, EPS negative, miss top bottom, CEO steps down, cuts guidance, says coronavirus impacted business, and I don't know if the stock would even go down. That's how crazy it is right now. I mean, I could literally have earnings in front of me before they get released, and I still wouldn't know how to trade it.
Yeah, it's a crazy world right now. Up is down, down is up. Markets are completely disconnected from the economy.
They are.
And so, basically the market has become a giant casino where your chance of making a profit is no better or worse than 50-50, because it's impossible to use fundamentals, and it's impossible even to rely on the technicals, because the technicals, thanks to the fundamental distortions, are also, they're not demonstrating the patterns that give us the ability to technically predict what should happen next. Instead, they're contradicting themselves and rendering technical analysis just as useless as fundamental. It's like, sure, go to the casino, get yourself a drink. At least the drink is free, and your chances of making a win are just as good at the casino, if not a little better, than in the market at this point.
It is so bizarre. And then you've had your names that have been so strong, like Twilio, Tandem Diabetes, Datadog, where Beyond Meat, even, where investors and the whole financial media has said, yeah, these are the great stocks right now. These are the stocks you want to be in. The stocks within 2 days are down anywhere between 7 to 15%. So those, quote, safe stocks that people have rushed into, and technically beautiful charts, they're getting their butt kicked right now. While you have a name like a Macy's printing 52-week lows is up 20% in a week. How's that for technical analysis?
Yeah, it's insane. So then, Lance, what about some of the non-traditional, well, not necessarily non-traditional sectors? Like, what are there ETFs we can look at? Are there, like, what's the game?
I'm gonna sound really boring, but I don't mind industrials right now. Your Honeywells, your Triple M's, your Caterpillars, your I can't believe I'm gonna say this, your GEs. If I don't mind those names. I don't mind materials, which is XLB, and I don't mind where are some of these utility names? It's just I don't mind utilities either. They're boring. They pay high dividends. I, I think you want to be patient and be very selective right now. The worst thing I feel like investors or traders can do is pick a stock that's been hot the past 2 weeks and say, well, look, it's down 5% today. I'm going to buy it. I think that is the worst idea out there. Or these guys and girls who go on and say, well, mRNA was at 75 a share. Now it's at 52. I'm going to dip buy it. I don't like, what has worked before is not going to work in the past. And that sounds really, really bad to say. But you can't go back to the old normal, I feel like, in trading, where you could get rewarded in the past for buying a dip in a quote hot stock. Not anymore. You're having the amount of Robinhood and retail traders out there have just flooded the market, and they need to feel pain. They've been on a free ride for the past couple months when they've dip bought, the mRNA or INO or Carnival Cruise Lines or American Airlines. They've had a free lunch, and that rug's going to get pulled under them to where, they get out the markets and they're, crying, oh, how did this happen? It was so safe just 2 weeks ago.
Right.
If you're really looking at it from an overall picture and you've missed out on the rally, or you're like, I can't believe stocks are going to continue to go up, look at boring utilities, industrials, XLU, XLI. You want to dabble and get a little speculative, look at KRE, regional banks, XLF. Even energy has been very solid recently. I even feel like if you haven't got an energy, you might have missed out a little bit, but look for some energy names even. It's hard to call tops and bottoms and say, this is the new, this is the new dip buy, this is the new rotation. I feel like you're playing with fire there.
Yeah. All right, Lance. Great comments as usual. Let's leave it there for now. We'll come back to you next week. Thanks very much for joining me today.
Thank you, James.